It was a bloodbath. Screens blazed red. Traders stared in disbelief. The numbers on the screens were not just numbers. They were the lifeblood of the global economy, and they were hemorrhaging. Panic spread like wildfire through the trading floors, and the once bustling hubs of financial activity fell eerily silent save for the occasional gasp or expletive. The Dow Jones, the Nasdaq, the FTSE, all plummeting at an unprecedented rate. It was as if the very foundation of the financial world was crumbling beneath our feet. Investors watched helplessly as their portfolios shrank and the value of their assets evaporated into thin air. The speed and severity of the decline were unlike anything seen before. It was Black Tuesday all over again, but this time there was no crash on Wall Street, no roar of a trading floor in chaos. Instead, the chaos was digital, a series of ones and zeros wreaking havoc in a way that was both silent and devastating. The echoes of history were unmistakable, yet the present felt surreal, almost dystopian. This crash was silent, cold, calculated. It was the result of algorithms executing trades at lightning speed, far beyond the comprehension of human traders. The very tools designed to optimize and enhance financial markets had turned against them, creating a perfect storm of automated destruction. It was the day the algorithm blinked. A momentary glitch, a miscalculation, or perhaps an unforeseen interaction between countless lines of code. Whatever the cause, the result was catastrophic. The algorithms designed to be infallible had shown their vulnerability, and the consequences were dire. The financial world woke up to a nightmare. Headlines screamed of market crashes and economic turmoil. People who had placed their trust in the stability and growth of the markets were now faced with uncertainty and fear. The ripple effects were felt far and wide, from individual investors to large financial institutions. Years of gains wiped out in hours. Retirement funds evaporated. The dreams of countless individuals, built on the promise of a secure financial future, were shattered. The impact was not just financial but deeply personal, affecting the lives and livelihoods of millions. The global economy teetered on the brink. The interconnectedness of modern financial systems meant that no market was immune. What started as a localized event quickly spread, causing a domino effect that threatened to plunge the world into a new economic depression. The fragility of the global economy was laid bare for all to see. Fingers were pointed, blame was thrown around like confetti at a ticker tape parade. Regulators, financial institutions, and technology companies all found themselves in the crosshairs. The debate over responsibility and accountability raged on with no clear answers in sight. The trust in the systems that underpinned the financial world was severely shaken. But one thing was clear: this wasn't a random event, a black swan. It was a failure of the very systems designed to prevent such occurrences. The algorithms, the artificial intelligence, the cutting-edge technology, all had failed in a spectacular fashion. The illusion of control and predictability was shattered. This was a calculated massacre orchestrated by the very technology we had come to rely on, artificial intelligence. The promise of AI was one of efficiency, accuracy, and the elimination of human error. Yet in this moment it had become the architect of chaos. The algorithms, devoid of human emotion and judgment, had acted with ruthless precision. The world held its breath. The immediate aftermath was a time of reflection and reckoning. How had we allowed ourselves to become so dependent on technology that we barely understood? The questions were many and the answers were few. The need for a deeper understanding of the systems we had created became painfully evident. How did we get here? The journey to this point was a complex one, filled with innovation, ambition, and a relentless pursuit of progress. But somewhere along the way, we had lost sight of the potential risks. The safeguards, the checks and balances had failed to keep pace with the rapid advancements in technology. How did the future of finance, a future seemingly brimming with algorithmic efficiency and AI-powered insights, crumble so fast? The vision of a seamless, automated financial system had turned into a nightmare. The very tools that were supposed to bring stability and growth had instead brought chaos and destruction. The answer, as with most things, was complicated, a tangled web of hubris, innovation, and the age-old vices of greed and fear. The lessons to be learned were profound, and the path forward was uncertain. But one thing was clear: the relationship between technology and finance would never be the same again. The seeds of this financial apocalypse were sown years earlier, in the gleaming server farms of Silicon Valley. A small startup, DeepSeek, had emerged from the shadows, promising to revolutionize investing with its proprietary AI. Their algorithm, whispered to be capable of predicting market movements with uncanny accuracy, became the holy grail for investors big and small. DeepSeek's success story was intrinsically linked with the rise of another tech behemoth, NVIDIA. The chip maker, once known primarily for its gaming graphics cards, had become the backbone of the AI revolution. Their powerful GPUs provided the computational muscle for DeepSeek's algorithms, and soon every hedge fund and investment bank was clamoring for a piece of the action. Money poured into AI-driven funds, inflating their values to dizzying heights. The traditional financial institutions, initially dismissive of this silicon invasion, were soon scrambling to catch up, pouring billions into their own AI initiatives. The market, drunk on the promise of algorithmic riches, had entered a new era, the AI gold rush, a time of unprecedented change. This wasn't the first time a revolutionary technology had sent the markets into a frenzy. Throughout history, we've seen how the promise of groundbreaking innovations can captivate the imagination of investors and the public alike. These moments of intense speculation often lead to dramatic rises in asset prices, followed by equally dramatic crashes. History is littered with cautionary tales of speculative bubbles where the allure of quick riches has led to financial ruin for many. These bubbles are often fueled by a combination of greed, fear of missing out, and the belief that this time is different. From the Dutch tulip mania of the 17th century, where the price of tulip bulbs reached extraordinary heights before collapsing, to more recent examples, the pattern remains strikingly similar. The dot-com bubble of the late 1990s is another prime example. During this period, the rapid rise of internet companies led to a surge in stock prices, only for the bubble to burst, wiping out trillions of dollars in market value. Each time the pattern was eerily similar: a groundbreaking innovation, promises of unimaginable wealth, and a herd of investors caught up in the hype, throwing caution to the wind. The excitement and optimism often overshadow the underlying risks and realities. Investors, driven by the fear of missing out, often abandon their usual caution and rationality. They become swept up in the euphoria, believing that the new technology or innovation will change everything and lead to endless profits. The allure of AI, however, seemed different, more potent. Unlike previous bubbles, AI promised not just a new product or service, but a fundamental transformation of entire industries. The potential applications of AI were vast, from healthcare to finance, and the possibilities seemed endless. This wasn't just about buying into a product or a commodity, it was about investing in the future itself. The belief was that AI would revolutionize the way we live and work, creating new opportunities and efficiencies that were previously unimaginable. Investors were not just buying stocks, they were buying into a vision of the future. The excitement was palpable and the potential for profit seemed limitless. The idea of being part of the next big thing was irresistible. The algorithms, with their ability to process vast amounts of data and identify patterns invisible to the human eye, promised to unlock a new level of market efficiency. They were seen as the key to making smarter, faster, and more accurate investment decisions. These advancements promised to create a world where profits were virtually guaranteed, where the risks of investing were minimized, and where the rewards were maximized. The potential for AI to transform the financial markets was seen as a game changer, a world where profits were virtually guaranteed. The excitement and optimism were infectious, and many believed that this time things would be different. The potential for AI to revolutionize industries and create new opportunities seemed limitless. But as the old adage goes, if it seems too good to be true, it probably is. The problem with speculative bubbles is that they're built on a foundation of sand, on hype and speculation rather than concrete value. The problem with speculative bubbles is that they're built on a foundation of sand, on hype and speculation rather than concrete value. The excitement and optimism often overshadow the underlying risks and realities, on hype and speculation rather than concrete value. And like all bubbles, it was only a matter of time before this one burst too. The inevitable collapse serves as a stark reminder of the dangers of unchecked speculation and the importance of due diligence and rational decision-making in investing. And like all bubbles, it was only a matter of time before this one burst too. The aftermath of such bubbles often leaves a trail of financial devastation, with many investors facing significant losses. It serves as a cautionary tale for future generations, reminding us of the cyclical nature of markets and the perils of speculative excess. Even as the AI-powered bull market raged on, a chorus of dissenting voices began to emerge. The excitement and euphoria that AI brought to the financial markets were palpable. Investors were thrilled with the unprecedented gains, and the stock market seemed to be on an unstoppable upward trajectory. However, beneath this surface of exuberance, there was a growing sense of unease. Economists, financial analysts, and even some within the tech industry itself warned of the potential dangers of this unchecked algorithmic exuberance. They pointed out that while AI could process vast amounts of data and make decisions at lightning speed, it lacked the human intuition and ethical considerations that are crucial in financial decision-making. The fear was that these algorithms, driven solely by data, could lead to unforeseen consequences.
"We're playing with fire," cautioned Dr. Emily Carter, a renowned AI ethicist, in a widely circulated op-ed. She emphasized that the rapid integration of AI into the financial sector was happening without adequate oversight or understanding of the long-term implications. Dr. Carter's concerns were echoed by many in the academic and professional communities, who feared that the reliance on AI could lead to a catastrophic failure if not properly managed. These algorithms are complex, opaque, and operate in ways we don't fully understand. The lack of transparency in how these AI systems make decisions was a significant point of contention. Critics argued that without a clear understanding of the decision-making process, it was impossible to predict or mitigate potential risks. The complexity of these systems also made it difficult for regulators to keep up, raising concerns about the adequacy of existing regulatory frameworks. To base our entire financial system on them is reckless in the extreme. The potential for AI to amplify market volatility was a major worry. In times of market stress, these algorithms could react in unpredictable ways, exacerbating downturns and leading to significant financial instability. The idea of a financial system driven by inscrutable algorithms was a chilling prospect for many.
Others, however, remained bullish. They saw AI as a revolutionary force that could transform the financial industry for the better. Proponents argued that AI's ability to analyze vast data sets and identify patterns that humans might miss could lead to more informed and efficient decision-making. They believed that with the right safeguards in place, the benefits of AI could far outweigh the risks.
"AI is the future of finance, there's no doubt about it," proclaimed venture capitalist Mark Stevens, a prominent voice in the tech investment world. Stevens highlighted the potential for AI to democratize finance, making sophisticated financial tools accessible to a broader audience. He envisioned a future where AI-driven platforms could provide personalized financial advice to individuals, helping them make better investment decisions. This technology has the potential to democratize finance, to make markets more efficient and accessible to everyone. The promise of AI was not just about making money, but also about creating a more inclusive financial system. By leveraging AI, financial institutions could offer services to underserved populations, bridging the gap between the financially literate and those who have traditionally been excluded from the financial system.
The debate raged on, a microcosm of the larger societal anxieties surrounding artificial intelligence. The clash of opinions reflected broader concerns about the role of AI in our lives. On one side were those who saw AI as a tool for progress and innovation, while on the other were those who feared its potential to disrupt and destabilize. Was AI a force for good, a tool to empower humanity? The optimists believed that AI could usher in a new era of prosperity and efficiency. They envisioned a world where AI could solve complex problems, drive economic growth, and improve the quality of life for people around the globe. Or was it a Pandora's box capable of unleashing chaos and destruction upon the world? The pessimists, however, warned that AI could lead to unintended consequences, from job displacement to ethical dilemmas and even existential risks. They argued that without careful management, AI could become a source of instability and harm. As the markets continued their relentless climb, these questions remained unanswered, hanging in the air like a bad omen. The future of AI in finance was uncertain and the stakes were incredibly high. The decisions made today would shape the financial landscape for generations to come, and the world watched with bated breath, hoping for a positive outcome.